Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are the day's top stories that we've been tracking for you in the BNN Bloomberg newsroom. Shares of Lithium Royalty are absolutely surging today, while shares of Altius Minerals are under pressure. You can see lithium's up by more than 28%, Altius down by about 1.5%. And that's because the Canadian-based explorer and developer is acquiring lithium for $520 million. Under the terms, Altius will gain ownership of 37 new royalties, with the vast majority of assets located in Canada, Australia, and South America. The acquisition will also create a significant pipeline to the battery metals component of its business. And shares of Baytex are moving today. Right now, though it's off slightly. It's because the company is unveiling its targets for 2026. Baytex plans to spend as much as $625 million in exploration and development, which is expected to generate production growth of 3 to 5%. The company says first quarter production is also expected to average up to 69,000 barrels of oil a day and then ramp up to 70,000 by the end of next year. And shares of NVIDIA are up 1.4% right now, and reports from Reuters that it plans to ship its H200 chip to China by mid-February. The report says the chip giant expects to ship up to 80,000 chips and also plans to add new production capacity, with orders for that capacity opening in the second quarter of next year. Beijing has yet to approve any purchases, and the timeline could shift. And taking a look at the markets, there you go. The TSX has topped 32,000. It is a record intraday high. We're looking at some of these numbers right now. It's up 0.84%. Looks like the Santa Claus rally is getting underway a little early. And south of the border, similar situation. Good start to the week down in the U.S. and the end of the year. S&P 500 up by 0.46. Dow Jones up by 0.4. NASDAQ up by 0.45. Gold and silver are hitting all-time highs today amid escalating geopolitical tensions. For more on this, we're joined by BNN Bloomberg's Lindsay Biscay. Lindsay, thanks for joining us. What's driving it? It's been a jump today.
It's been interesting to see just how much it's been going up. A lot of economists are saying what's driving it is maybe geopolitical tensions, right? What's going on in Venezuela, Ukraine striking a Russian oil tanker in the Mediterranean Sea. But more so, we've heard some people say that there's always geopolitical tensions. And really, that might not be the main driver. Yeah, especially 2025. There's been a lot, right? And that maybe isn't the main driver here. Maybe it's more the potential for further rate cuts in 2026. A lot of economists looking at the Fed, looking at some decisions that might come early in 2026, expecting at least 2 rate cuts. And that's potentially why we're seeing the price of gold, the price of silver, the price of copper going up today. So, and throughout the year too, it's been wild to see gold up more than 70%, silver up more than 140% year to date, and copper up almost 40%. Yeah, silver is the really interesting story here. But just before we get to silver, like looking at gold for today, it's up above $4,400 an ounce. Silver spot reaching a record high at $69.04 an ounce. That's up almost 5% from its close on Friday. And then copper is also up about toward $12,000 a ton. So seeing some incredible runs here. And yeah, it's been interesting to just see exactly what's happening and why. But obviously why it is the main factor here. And a lot of that is because there's expected rate cuts in 2026. And
always a big thing for gold, safe haven. Silver, a little bit like that as well, but also demand for it right now. And it's outperforming by a mile what gold is doing.
That's what's always so interesting to see, right? Silver just doesn't get that hype that gold seems to get. But silver, Apparently, to some, right? Silver just has not been, it's been performing more than it has gold, as you mentioned. Like we were talking earlier with Peter Hodson with I2I Capital Management. He says silver has been outperforming gold because of physical demand for it. Like there's not as much production of silver as there is of gold, but the demand for silver is going up because it's being used more for AI data centers. It's being used a lot for that. It's used in semiconductors, switches, controllers, and that's why we're seeing this kind of demand for silver, a demand that kind of outpaces supply. Here's more on what Hodson had to say about that.
But it also is an industrial use. It's a great connector. It's a great conductivity metal. And it's now getting lots of usage in AI data centers with cooling applications, connectivity applications. And this has kind of come out of nowhere. Silver is kind of, over the past 18 months or so, it's like, you know what? It's now an AI stock, or it's an AI metal. And of course, everything AI has gone a little crazy. And so you get that kind of extra boost in addition to all the other things that are helping out gold. So I think silver probably outperforms in the short term. The big question, of course, will be what happens when there's a crisis in the market or there's a crisis in the economy, because that industrial usage for silver will hurt it when people get scared of the economy or they get into worries about a recession.
So really interesting to see. Hodson says he doesn't expect the same returns for gold and silver in 2026 that we saw throughout 2025, but he does say there's a lot of momentum right now for a lot of these metals, and so we should see that continuing at least for the near future.
Okay, we'll leave it at that. Actually, we're not going to leave it at that. We're going to talk more about it. Lindsay, thank you though for joining us as always. BNN Bloomberg's Lindsay Biscaya. Now, for more on the record run for metal prices, we're joined by Paul Harris. He's a portfolio manager at Harris Douglas Asset Management. And thanks as always for joining us, Paul. We appreciate it.
My pleasure.
What are your thoughts on what gold is doing right now and the little run it's had? We saw that the drop earlier, about a month or so ago, but that seems to be long in the past. What's fueling this run right now?
Well, I think a lot of things that you've already talked about. I mean, one is kind of the geopolitical issues that are facing the world. So whether it's Venezuela, whether it's Russia, Ukraine, that continues to be just to give you a strong base to why you want to own gold. I think also the other thing is that there's been sort of this massive increase in fiscal deficits around the world, right? And I think that sort of people are really worried about kind of the monetary value of their currency anymore. And so I think that's helped gold a lot, as it sort of, kind of people felt compelled to own Bitcoin to a certain degree for that. So I think that's another reason why you're trying to see kind of, gold and be so strong over the last little while. So I think the other thing is that the other thing we have to remember is that the U.S. is going through a very unique situation with the Federal Reserve, where you're going to see somebody new at the Fed, and that decision is going to be made either later in this year or early next year. And I think that people are sort of concerned about who that person is going to be, whether they're going to be an individual that will actually take their job seriously, as opposed to being a substitute for the president of the United States. And I think that's really important. And so gold is kind of reacting to, I think, looking at those issues and determining whether we're going to see a more normalized Fed with Powell leaving, or a Fed that is, has much more to do with pleasing the president. And I think that's really an important part. And that kind of those monetary issues are really important. The Federal Reserve is the most powerful central bank around the world. It sets a lot of things, that how the world kind of how interest rates will look, all those other things. So I think that's one of the things. And finally, I think that even we saw sort of what was perceived as good inflation numbers, I think the tariffs and all these other things will definitely have much more of an impact on the U.S. economy in 2026. And I think the market, the gold is reacting to maybe what you're going to see is, higher inflation numbers as we go into 2026, because the inflation numbers that came out were very they weren't, I think, although they looked good, I think people were very worried because of how they've kind of structured them because of the shutdown, et cetera. So I think there are a lot of questions about the inflationary numbers, and I think you'll see more clarity on that in 2026.
Just going back to the Fed, if they do get a cut replacement, what kind of an impact would that have on gold?
Well, I think that one is that is if the cuts are perceived because are done because of the fact that the economy is slowing and all those other things are happening in the economy, that's a very different story. If the data shows all those things, I think the worry is that the data won't show that you'll have people on the Fed that just say we're cutting rates because the president wants that, and whether the Fed is the Fed is an independent organization, right? And so that will disappear, and so the ability for anybody to trust what the Fed is going to do will hurt the world and also the U.S. economy, because it could lead to substantially higher inflation if the Fed cuts too much as opposed to cutting because the data is showing that the economy is weak, right? So I think that's the whole problem. So if you have a Fed that is doing something because the president wants to, like happened with the Nixon era, where you saw massive increase in inflation, I think that's what the economy and even the bond market to a certain degree has been worried about, because when you saw inflation numbers come down or even interest rates come down, the bond market in the long end went up. So the bond market is unsure about where all these things stand.
And what are your thoughts on, I've heard talk of $5,000 an ounce for the end of the year. Is that a possibility?
I mean, I think there's lots of momentum in gold and in silver right now, and I think that that's a real possibility when you see that kind of momentum in any kind of asset class, right? So, and the other thing, of course, is many portfolio managers didn't own gold or don't own any gold because they don't see it as in a similar way as maybe other institutions do, and so now towards year end, they don't want their portfolios to say, "Oh, I didn't own any gold." So they, sometimes there's a momentum based on putting in certain things at quarter end, in the stock portfolio, or in this case with things. So you may see that may be creating some momentum in gold as well.
All right, and with silver, some safe haven to it, but some different factors that are driving it, and it's outperforming gold this year.
Yeah, I mean, the gentleman you had on talked about it as it's become much more of an industrial commodity. Gold is really not an industrial commodity outside of it's for jewelry, et cetera, or held as some kind of a monetary offset, where silver is used in some industrial methods. So I think that's helped silver a lot. And silver, you have this kind of thing with silver where it tracks gold, and you have this kind of occasionally where it outperforms. And I think that's what's happening now, because people are looking at it as, oh, I don't want to buy gold, but I'll buy silver because it was cheaper at the time, right? So maybe that's helping out silver a little bit here, and the fact that it's being used as an industrial commodity.
All right, and what about, we're almost out of time, but copper, and then even like platinum and palladium?
I think all these metals have had sort of this kind of momentum because of what's happened with around the world. Copper certainly because it's used, as an industrial metal, and you've seen certainly a lot of issues with build out of data centers and all these things, and so it's definitely that's one of the reasons why copper and also all these metals have certainly gone up because there's been huge momentum on that side that the economy needs a lot of these metals. And so I think that's what's really helped the metal sector and helped the stock market in Canada, right? Because you've seen we're very big in metals and minerals in this area. So I think that's really helped the TSX. But I think that, when you have a momentum with these kind of things going up, all of them go up together, right? And I think that's exactly what's happening right now.
Okay, we're going to have to wrap it up there, but Paul, thanks as always for joining us. Always a pleasure, and all the best for the holidays.
My pleasure. Thank you.
Paul Harris, Portfolio Manager at Harris Douglas Asset Management. Up next, we'll tell you why there is a sense of uncertainty among dairy farmers as Canada prepares for negotiations over the deal with our North American trading partners. There is a sense of uncertainty among dairy farmers as Canada looks to renegotiate the trade deal with the U.S. and Mexico. CTV's Jeremy Sherrill has more.
Does this 24 hours a day, 365 days a year.
For more than half a century,
I've been doing this, my whole life, but I took over from my dad in 1992.
Dairy farmers like Peter Reuter have been protected.
When you drive by my farm, know that behind the door there's a farmer like me producing the milk to their standards that they want, healthy, pure, and local.
Canada's supply management system means the industry and its producers are afforded certain safeguards. Quotas and minimum price guarantees ensure stability and predictability Supply management also protects the domestic market, limiting import access.
It's not competing against the American producer. It's competing against American subsidies.
But in dairy farms like this one across the country, there is a sense of uncertainty. Concern over what CUSMA renegotiations in 2026 could mean for the system that local producers have long been accustomed to.
There comes an end point where it's not worthwhile to, give up that much market share. So we can't give up more.
This week, U.S. Trade Representative Jamieson Greer told Congress the dairy industry would be a priority in upcoming trade negotiations. Under the current agreement, the U.S. gets tariff-free access to about 3.5% of Canada's dairy industry. They're pushing to expand that. Prime Minister Mark Carney has repeatedly said supply management will never be on the table in negotiations, a position he stood by when asked Friday.
Not on the table. We'll continue to protect supply management.
In a statement to CTV News, the president of the Dairy Farmers of Canada says they expect this commitment to be honored as the CUSMA review process continues. But here on the farm, the threat is hard to ignore.
If anything were to happen, it'd be vitally impossible for me to continue.
A harsh reality Rooter and the dairy industry as a whole hope they won't have to face.
Compared to the U.S. farms, I'm miniature.
Jeremy Sherrill, CTV News, Ottawa.
Well, it's been a year in which many in our country have come together, united by a common goal to stand up for Canada. That includes the premiers of the provinces and territories, Team Canada. They came into focus in 2025 on the front line of the trade fight. But as CTV's Andrew Johnson shows us, old interprovincial rivalries were also renewed.
In a year that started out looking like this.
I think Canada is going to be a very serious contender to be our 51st state.
We're going to put very serious tariffs on Mexico and Canada.
Canada's premiers, the faces of each province, became a focal point of resistance against Donald Trump's trade threats.
As Canadians, we need to realize that he is not joking.
Each standing up to defend their provincial and territorial economic engines on behalf of Team Canada. An early move, all but two, opting to remove U.S. liquor from store shelves. Manitoba's Wab Kinew took a page right out of the American president's playbook.
It's a wonderful order. It's a beautiful order. This order is pulling American booze off the liquor mart shelves.
At the White House in February, the premiers met with members of the Trump administration, presenting a united front.
The worst thing we could do as a country is not show up.
For Ontario's Doug Ford, showing up meant going on the offensive, threatening to punish America by any means possible, including restricting power sales.
If the United States escalates, I will not hesitate to shut the electricity off completely.
Ford even urged Alberta to put an export tax on oil.
Their gas prices go up $90 to $1 a gallon. They will lose their minds.
That did not sit well with Premier Danielle Smith, who called the idea absurd and self-destructive.
You can ask me as much as you like. The answer is no.
Smith, who'd been criticized for visiting Trump at his Mar-a-Lago home in January, said diplomacy, not retaliation, was the best way to deal with the president. The Team Canada narrative was also interrupted in May, when supporters of Alberta separation celebrated a Smith government bill that would make it easier for voters to force a referendum. Smith said she didn't support separation, but also wouldn't stand in the way.
I will respect the outcome of citizen-initiated referenda, and that's why it's my job to make sure it doesn't get to that point.
I want to welcome everyone.
By summer, 6 months into the trade war, premiers and territorial leaders were in Ontario cottage country, talking trade, tariffs, and teamwork.
Right now, our economy in all Canada suffers because of the uncertainty.
Another goal of the three-day summit was to make it easier to move goods between provinces at a time when many discovered buying Canadian could be difficult.
I can't say how many times I've heard it's easier for me to access Alabama than Alberta.
In late September, Trump again turned up the heat, announcing new tariffs. Ontario's response got under the president's skin.
When someone says, let's impose tariffs on foreign...
A $75 million ad campaign airing on major American networks starring former President Ronald Reagan.
Over the long run, such trade barriers hurt every American worker and consumer.
Trump called the ad fake and promptly ended Canadian trade talks.
They did a crooked ad. They know it was Ronald Reagan loved tariffs.
Ontario ended up pulling the campaign early, but the man who authorized it was downright Trump-like in declaring its success.
It was the most successful ad in the history of North America.
It was around this time cracks in the Premier's Team Canada collective widened out west over Alberta's pitch for a new pipeline to send bitumen to BC's northwest coast. Despite a hard no from BC's David Eby, Danielle Smith pushed to have the proposal added to Mark Carney's major projects list.
Premier Eby's comments are un-Canadian and they're unconstitutional. All it takes is the Prime Minister to say yes.
It's not the Danielle Smith show, it's the Canadian team. And we all deserve the same opportunity for the same federal funding for our projects as she does for hers. That's not un-Canadian, that is fair.
Smith got what she wanted, a memorandum of understanding signed by the PM.
I think it's going to unleash an incredible amount of investment.
As 2025 comes to a close, with Canada and the U.S. still deadlocked on a trade deal, we can expect a continued focus going forward on the premiers, advocating for their provinces and territories and trying to get along. Andrew Johnson, CTV News, Vancouver.
Coming up, we'll look at some of the stocks on the move today, including a deal in the lithium space with Altius making an acquisition. All right, for more on some of the stocks on the move today, we are joined now by Bloomberg Equities reporter Monique Malima. Monique, thanks as always for joining us. And first up, we're talking about Altius and lithium royalty. A bit of a sale going on there, and the stock's going in different directions.
Hi, yes. So like you mentioned, there is a sale. So Altius Minerals is going to be buying lithium royalty for about $520 million. And this is about what analysts are saying is a 30% premium for lithium royalty. So that's why we're seeing their shares up so much today. They see this as really positive for the company in terms of the price that it was able to get. And they also note that because of the low breakup fee in this deal, that lithium royalty might also be able to consider some other potential bidders if some emerge. So they see it as overall really positive for lithium, but Altius, like we mentioned, maybe slightly overpaying, so that's why we're seeing some pressure there.
Okay, and next up, T1 has a new deal.
Yes, so T1 Energy, they're in the solar energy space, and they announced this morning that they have a deal with Treaty Oak for about 900 megawatts of solar module capacity. And the big news out of this deal, in addition to the size of it, is the fact that 60% of the production for these modules is going to be domestic in the U.S. This is a company that's faced some difficulties in terms of their manufacturing. Some of it was out of China previously, and the U.S. put in place these foreign entity of concern rules around manufacturing that targeted the solar industry. So this is showing that the company is really on track to meet these requirements from the U.S. They're going to have a lot more U.S. production, and they have this big deal in place now for these solar modules. So this is why we're seeing that positive growth in the shares today.
Okay, and last one we're talking about today is Baytex increasing production. Not a ton.
Yes, so Baytex, they gave their production guidance for next year. They're expecting to see about 3% to 5% growth in production. And this is something that analysts say is really in line with expectations. Overall, this is what people had been hoping for, that there would be that growth in production. Most of it is going to be coming from the oil segment, but they say that for the oil segment, there's going to be a good amount of production growth and also strong free cash flow. And they said this is going to be really helpful for the company going forward. Oil prices are expected to face some pressures next year on potential oversupply. So having that free cash flow is going to be helpful for the company. And they also see more opportunities for growth going forward.
Okay, Monique, we'll leave it there, but thank you as always.
Okay.
Bloomberg's Monique Malima. When we come back, we'll look at the dramatic reversal in the number of asylum seekers crossing the border into Canada from the U.S. Canada will weigh opening its housing market to more foreign home buyers. In an interview with Bloomberg News, Housing Minister Gregor Robertson said Ottawa will maintain its current ban on foreign buyers through 26, but will consider changes for 27. Robertson says Canada needs to ensure housing is built and owned by and for Canadians first, and Ottawa will review what has worked in other countries, particularly Australia. Well, shares of Warner Brothers Discovery and Paramount Skydance are rallying. The continued battle in a takeover bid to take over Warner Brothers. Paramount's amending its bid for the entertainment giant, and it now includes a personal financial guarantee by Oracle chair Larry Ellison. Ellison has agreed to provide a guarantee of $40.4 billion U.S. in equity financing for Paramount's proposed bid for Warner. Paramount is also offering to increase its regulatory reverse termination fee. Shares of Honeywell are off today after the aerospace and industrial conglomerate lowered its full year and fourth quarter outlooks. The move comes after reclassifying its advanced materials business as discontinued operations following its spin-off. Honeywell also expects to pay a one-time cash settlement of $470 million U.S. related to the FlexJet lawsuit. FlexJet is a private jet services company that sued Honeywell for a breach of service agreement. And looking at the markets right now, you can see it is the rally continuing where it left off on Friday, and the TSX up in record territory, over 32,000 for the first time ever, and it's up nearly a full percentage point today. South of the border, similar situation, the rally holding there as well. Look at those numbers, 0.59 for the S&P 500, 0.55 for the Dow Jones, and 0.57 for the NASDAQ, all in the green. Well, amid the rush to finish up holiday shopping, new reports find that many Canadians are choosing to spend less this year. Families are looking for savings just about everywhere, with one big exception. CTV's Colton Prale has more.
It's the season of giving. Merry Christmas! But some Canadians find themselves giving
less. And you can do it if you're good at knowing what the prices are.
A new survey from TD Bank found more than a third of Canadians are cutting back on holiday spending, up from last year.
Me and my partner decided actually not to exchange gifts between the two of us this year. It's so expensive.
It's not just presents under the tree that are getting trimmed. According to TD, of those planning to save this holiday season, nearly half are cutting back on social spending.
Especially with groceries, are way more expensive, so it makes like hosting and having parties a lot harder.
But even as holiday budgets decrease, 46% of people are actually spending more money on Canadian products, according to Business Development Canada. At this Ottawa artisan shop, that's leading to a boom in new customers.
When folks can check all the boxes and they're not draining their bank account or taking out loans just to support the Canadian economy, then it's a win-win.
Still, according to TD, over 3/4 of Canadians admit they're vulnerable to overspending on the holidays, feeling the pressure to create memories or spend extra to give meaningful gifts.
It is something we're willing to pay for because we really want to support Canadian producers and makers of products.
According to a report from Business Development Canada, if families spent an additional $100 of their expected holiday shopping on Canadian products like this one, the benefit to the national economy could be as much as $2 billion.
And that was CTV's Colton Prale. A term called thriftmas is turning out to be popular this year. Instead of buying fully priced items, some shoppers are opting for secondhand. CTV's Sarah Plowman has more.
The aisles map the route. Shelves hold the treasure. Thrift stores are full of finds, and Paige Morgan is out to discover them for Christmas.
It's better for the environment. And then my pocket. I have a very small pocket.
We have a lot of...
As higher costs drag bank accounts down, thrifters have more company. Home care worker Kathy DeLong helps seniors, and today is helping those who are shut in shop for Christmas.
Everybody's on a fixed income, and especially seniors. They got to watch their money very carefully.
Thrift stores have noticed a lot of traffic this season.
We sold a lot of toys. A lot of families that are coming in that can't seem to afford the full cost of a lot of the stuff, but still want to give the kids things.
Same down the road, where shoppers scoop up furniture or decorations.
It's those, a lot of times it's those unique gift ideas as, oh, I'm looking for something really interesting for a family member. And
this Fredericton consignment store has also noticed a bump in sales.
I think people have caught on that you can stretch your budget further and not sacrifice quality or the styles you want.
Beyond the discount, store owners highlight other perks.
You're not having to, get into the commercialism and you're repurposing valuable things, people that have loved in the past, and they're getting passed on so someone else can love them just as much.
Another reason for this mom to buy her kids' toys here.
Some toys he gets that are for gifts, I find them in the thrift store, like for $5, and it's just better to get them here instead of them going to the landfill.
Swapping Christmas for Thriftmas. One find at a time. Sarah Plowman, CTV News, Fredericton.
Coming up, we'll get an outlook on the airline sector with independent aviation analyst Stephen Trent. North America's airline sector has seen much uncertainty this year, from strikes to facing the realities and toll tariffs have taken on consumers. Let's take a closer look at the company's latest results with Stephen Trent, an independent aviation specialist. We began by asking him about the fixed fortunes for U.S. Airline.
When you look at the big three, Delta, United, American Airlines, we're actually bullish on the 2026 outlook. I would say of that trio, American Airlines potentially has the most exciting story. But I think a lot of this begins with the consumer. So I think you have to bifurcate the U.S. consumer between wealthier folks that are invested in the stock market and everybody else. So that former category, you still see very good demand, and you still see people that want good experiences on board. They don't want to be stuck in a cattle car. They want one of the big three. And that's why you see, basically the discount airlines all want to push premium, which I think is an uphill climb.
That's right. People, their whole model is not providing fancy added services. Yeah. The could just talk a bit about American, though, if you would. I know its stock has rallied lately, but it is still down this year, AAL shares. Why is that?
Yeah, great question. So you've actually seen a lot of broad chop in the space. So the year started really bumpy, a great deal of uncertainty and concern on tariffs. You actually, unfortunately, had a couple of very high-profile aviation accidents. None of this helped in terms of higher-end consumers and companies planning business travel for the year, or even planning leisure travel. Mm-hmm. So we have seen some recovery in the stock, but when one looks at the equity market value, American looks mispriced versus Delta and United. It's still hovering around its pandemic-era equity market cap. That's in spite of the fact that we've seen a significant improvement in free cash flow. We've seen a significant deleveraging. And 2026, when we think about the potential for them to catch up from a unit revenue perspective, that, in my view, looks like a pretty exciting opportunity. So we think even today, American Airlines shares are oversold.
What about Delta? Anything in particular going for them? Any particular tailwinds for that company in 2026?
Yeah, look, so for all three of them, you have the consumer. Oil prices down, and I think it's fascinating. You see a little bit of an uptick in oil on, the Venezuela stuff going on at the moment. But if one looks at oil over the last 2 decades, in real terms, oil's down substantially in real terms. If we take that oil curve and adjust it to 2025 inflation. So if you're at Delta, you've got really fantastic hub at Hartsfield. You have a robust co-branded card program with American Express. And then you have very good premium, very good lounges. I think in Delta's case, however, they're a fantastic airline, but it's probably unlikely that good to very good results from them are going to surprise anybody. I think you're going to see kind of the opposite. In Americans' case, they have good to very good results come through, and I think there's a good chance that surprises the street.
What about Southwest? Of course, they were the original discounter, well, with their model of a very simple fleet of 737 aircraft. Stock has done okay this year, up about 23%.
Yeah, absolutely. So Southwest is an interesting case. So on a fundamental level, its forward PE is trading far above where it traded pre-pandemic. If we look at the stock from a pre-pandemic basis, it had very good EBIT to free cash flow conversion, basically doing about $3 billion in each bucket. Today, if one looks at Southwest EBIT to free cash flow conversion, it's actually a much poorer scenario in both cases. So if you look at Southwest latest 12-month cash flow from ops versus American Airlines has done more than double cash flow from ops that Southwest has. What investors are focused on Southwest case, they certainly have a really good balance sheet. They have a formidable activist shareholder behind them, which I think seems to be doing some things that are potentially beneficial. But I would argue a lot of that's priced in. I'm not so sure I'd be making a bullish call on Southwest for 2026 at these valuation levels, especially given the poor EBIT to free cash flow conversion they have today. They've actually been burning cash.
One thing I have only really learned about lately is the vital importance of these co-branded credit cards to airlines, not just for building loyalty among passengers, but they're a crucial source of revenue as well.
100%. And when one looks at these co-branded card programs, I think you said it very well. Not only do you have remuneration on the income statement with the card program paying a royalty, for example, but much more importantly, from a free cash flow perspective, when one thinks about the working capital impact of that, the liability growth, because in most consumers' cases, people are generating miles in their credit cards. You know, not everybody today is spending all of their miles, for Christmas shopping. And the rate at which you can generate points and the rate at which you can redeem points are absolutely not the same. So what we've actually seen from the big three that, quite frankly, have by far the best co-branded card programs, we've actually seen this growth, this remuneration growth, actually go a long way in terms of de-risking the earnings streams. So American, for example, has its new program starting next month. We're kind of excited to see where they go with that one.
Andy was speaking with Stephen Trent, an independent aviation specialist. We'll have more coming up after the break. Transcripts, which specializes in data encryption and has the governments of Turkey and Ukraine as clients, which their aim is to get key information to citizens securely. And it recently did a $20 million seed round backed by leading venture funds. Earlier, we spoke with Transcripts CEO Zain Zaidi, who was recently named one of Forbes 30 under 30.
While we've been doing great on the enterprise side of things, what we did about 2.5 years ago, 3.5 years ago, time flies, is at the start of the Ukraine war, we enabled Ukrainian refugees to get access to their verified medical records. So traditionally, medical records are stored at hospitals. It's very hard to access hospitals in an active war zone. So we enabled on-chain, self-sovereign medical records that we gave access to these refugees so that when they received treatment in Europe or wherever country that they were going to, they had access to these credentials. So to date, we've serviced over 100,000 such refugees in Ukraine, as well as in Turkey and a handful of other countries.
And that's incredible to hear. And how important is that, then, social enterprise to your company?
Extremely important. We've built Transcripts with kind of the goal, and it's our ethos, actually, that we want to build a company that does good. Obviously, we are a for-profit business, so for our shareholders, but also have used some of our technology, give it on a pro bono basis to nonprofits and other institutions that could use it for good.
And what's the benefit for you with that?
Yeah, well, the first major benefit is kind of on the personal side, right? Both my parents are immigrants, so it kind of touches us personally. Same with my co-founder. We view the world not necessarily just as Canada only, but as a global society, and we want to help out people globally. But second of all, I think technology as a whole has kind of developed a bad reputation for itself. I've spent a good amount of time of my life in the Silicon Valley. Things like AI, crypto, all these buzzwords. If you ask the average person of them, they don't necessarily have the best opinion of these words. And that's because there's fear. And quite frankly, some of these technologies have been used to disadvantage a good chunk of the population. So we hope we can change the narrative and show that technology can actually be used for good.
And let's talk a little bit about the company itself. What's the focus for you?
Yeah, in the Canadian market, we're primarily enabling Canadians to own their verified employment and income credentials. We want you to be able to own where you work, how much money you make, and ultimately disrupt the model that the credit bureaus have. To date, we've scaled that business quite rapidly, 30x in the last 2.5 years. Now with that seed round funding, we're going to continue that growth here in Canada, as well as the United States. Actually, I was just recently informed that we are the fourth or fifth largest provider of employment and income data, right behind the 3 large credit bureaus. So we're pretty excited to be continuing to double down on that mission and enable people to own their own verified employment history.
And what are you doing different from them that you think you can move past them?
Yeah, so the credit bureaus they serve as middle parties. Banks, landlords, employers rely on these credit bureaus to verify and validate our own information, whether that be your credit score, where you've worked, your income history, et cetera. What we're doing is we're giving consumers the ability to actually own their verified record. So we integrate with truth oracles, like we like to call them, that can be like HRS databases, so the human resource information systems at large enterprises, and they can then, using that information, they can prove that they've worked at these enterprises. They can then take that verified record and share that directly with a third party, like a lender, a landlord, a future employer, directly, not having to rely on the credit bureaus. Doing it this way is a lot more compliant with both Canadian and U.S. law, but also, quite frankly, a lot more efficient because you don't have to have a middle party going and fishing these records. And also, from a data privacy and data security perspective, the only person who has access to your credentials is you and the person that you decide to share it with. So we think it's just, all in all, a much more efficient system.
That was Zain Zaidi, founder and CEO of Transcripts. Well, the flow of asylum seekers arriving in Canada via upstate New York has plunged, a sharp reversal from the start of the year into the summer when thousands of people were trying to get through the Canadian border. To talk more about this, we are joined by Mathieu Dion from Bloomberg. And Mathieu, thank you very much for joining us right now. We appreciate it. Talk a little bit about the story. What led to it? What's the situation now on the border?
Yeah, well, if you go back a few years ago and you remember this tweet made by Justin Trudeau saying that if you're fleeing persecution, you're actually welcome to Canada. But this policy of open doors is now something of the past. There was some tightening in immigration policies that were started under Trudeau and continued by Mark Carney, especially for temporary and permanent residents. Now, for asylum seekers, rules have not changed. But when we talk to lawyers and experts, they say the way that border agents apply rules now today is much more different. It's much more, you need a lot of evidence to prove that you have family ties in Canada to seek asylum. Because right now you do have an agreement between Canada and the US, the Safe Third Country Agreement, that says technically, if you're coming either from Canada or US, these two countries are safe, so you should not seek asylum. But there's an exception in the agreement that if you have family ties in Canada, then you can seek asylum. Mm-hmm. So in the past, few questions were maybe enough, but today you need a lot of documentation to prove that. So it's much more difficult than it used to be to enter the country. And over the summer, we saw a spike of asylum seekers coming from the US because of Donald Trump's crackdown on immigration. But the number of asylum seekers have gone down quite significantly in November. Actually, the number of asylum seekers coming from the mainland port of entry in Saint-Bernard-de-la-Côte, not far from Montreal, was down in November compared to last year for the first time in a long time. So it shows that it's much more difficult now to enter the country. And overall in Canada, in 2025, there were 42% less asylum seekers, people asking for asylum in Canada than in 2024. In the meantime, the number of removals, deportations were up 15%. So that says a lot about what's going on right now.
And why are the numbers down of people trying to get across? Are they worried what happens to them if they're sent back?
Exactly. So right now, it's much more difficult to enter a country. I should also say that there's much more surveillance along the border with drones and cameras. So it's much more difficult just to cross into a forest and not get caught. And yeah, the word is circulating that it's difficult to come to Canada now, and you need a lot of documentations. That's what the experts are telling us for the moment. So yeah, I mean, it's not like it used to be to come here to Canada.
With ICE. Now, not everybody is in favor of this. There are some former politicians who are saying this isn't the way to do it.
Exactly. And especially with what's going on in the U.S., with ICE doing its crackdown right now, we should actually welcome more people. And there's a lawyer that also told us that if you close your border like that, actually they'll find other ways to come in. So that's another problem that may come up down the line.
And have we heard from the government on that? Just quickly.
Yeah, well, yeah. Just to be fair, I should also say that CBSA actually said that there's actually no new rules, no directive that were given to border agents. So that's that. But the lawyers and experts we're talking to have a different opinion or interpretation of what's going on right now. But CBSA denies that there are more severe restrictions.
We're going to have to wrap it up there, Mathieu. Thank you.
Or restriction.
We're going to have to wrap it up. I apologize, we're out of time, but thank you very much for joining us.
No worries, bye.
BNN Bloomberg's Mathieu Dion. And that's it for us on Morning Markets. We'll see you tomorrow. Thanks very much for joining us.